Inventories, Part 6. I'm Judith Paquette. We are now moving on to the lower of cost or market basis for accounting. It's important that you understand the impact of inventory cost flow assumptions on the income statement and balance sheet, and we'll do some more work on those in the next video. Lower of cost or market. When you buy goods at a certain cost, and later on the market value of that cost is lower than what the company paid for it, companies are permitted and in fact required to write down their inventory to its market value during the period in which the price decline occurred. For this purpose, market value is equal to replacement cost. Now, you don't write down your inventory automatically if there's a fluctuation in pricing. But what we're saying is if there's a consistent decline in value, the company may write down their inventory to market value. This is being conservative, which is a value in accounting. We do not want to overstate assets. And so if the market value is so much lower than what the company paid for the inventory, we have to write it down. And this is a loss to the company. And this is another reason why you don't want to have a lot of extra inventory around. This is an exception to the historic cost principle, where you always value inventory at its historic cost. And the reason it's an exception is because we're trying to be conservative. We don't want to overstate the inventory account. This analysis can be done at the item level, by individual products, or at the item category level. So we're going to show the item level right down. So imagine that you have three different products, product A, product B, product C, on your books. And this is what they're valued at on your books. You have 100 of product A at $52 each. You have 50 units of product B for which you paid $75 each. You have 35 units of product C, which cost you $105. Now you're going to compare these three products to their current market value. Product A you bought at $52, but it's currently selling. If you were to go out and buy it today, you would have to pay $62. So the price has gone up since you bought it. We will value this inventory at the lower of cost or market, so we will not write up this inventory. We will keep it at the $52 times 100 units and value that inventory at $5,200. Product B and C are a different story. You can see the price went down for both of these. Product B had a loss of $15 a unit. So we're going to value this inventory at $60. 60 times 50 is $3,000. We're going to value product C. We're going to revalue it at 74 times 35 is $2,573. So our new value of our inventory is $10,773. So we did take a write down of $15 times 50 of $2631 times 35. So the company will write down the inventory. A journal entry will be made to credit the inventory account for the difference, and we'll record a loss. We'll debit an expense account, loss on inventory valuation, or some companies may just take it directly to cost of goods sold. So that's lower of cost or market. Inventory errors. What causes inventory errors? A common error cause is accounting error or a pricing error. There might be ownership issue errors. Who has title to the goods? Maybe you thought you owned the goods, but they actually belong to the seller. Maybe they were consignment goods that you weren't supposed to count. The important thing to know is that two things. Errors will affect both the income statement. Inventory errors will affect both the income statement and the balance sheet. And one error in ending inventory will affect the current year financial statement and the next year. Let's take a look. Situation 1. Year 1, Inventory was overstated. Maybe you counted consignment goods that you shouldn't. This will roll through and make cost of goods sold understated. Because remember how we calculate cost of goods sold. Inventory plus purchases minus ending inventory equals cost of goods sold. So that error will roll through to cost of goods sold. If cost of goods sold is understated, net income will be overstated. That's year one. Let's take this situation into year two. Remember, if ending inventory is overstated, for year two, beginning inventory is overstated. If there are no more errors, beginning inventory will be overstated, and let's say you count ending inventory that year correctly, then that error will roll through to cost of goods sold, and then it will be fixed. Cost of goods sold will be overstated for year two, and net income for year two will be understated. Let's go back and say situation number two. What if you understate ending inventory? Why then, cost of goods sold will be overstated and net income will be understated in year one. If you understated ending inventory in year one, in year two, the beginning inventory will be also understated because it's the same amount. If beginning inventory is understated, cost of goods sold will be understated, and net income will be overstated. The accuracy of the income statement is dependent upon the accuracy of the physical inventory. So when companies take physical inventory, they're very precise. Analyzing inventory. How much inventory should a company have on hand? If you have too much inventory, you have some risks. You have high carrying costs, your investment, your storage, your insurance, the people, the labor it takes to take care of inventory, and of course the risk of obsolescence and damage. If you have too little inventory, that may lead to stockouts and lost sales. Think about it. Do you return to stores that consistently run low of inventory? Probably not. And finally, inventory ratios. There are two important ratios with inventory. Inventory turnover measures the number of times on average the inventory is sold during the period. This is calculated by taking the cost of goods sold divided by average inventory. Cost of goods sold will come from the current year's income statement. Average inventory is a calculation where you'll take the current year's inventory balance, the prior year's inventory balance, and divide by 2 to average. We then take this total and use it in days in inventory. Days in the year, 365 divided by inventory turnover. So think about something like lettuce. You would hope days in inventory would be maybe 3 to 4 days. But something like a canned good could be 40, 50, 60 days old, and it wouldn't be a problem. And so that's what we use when we analyze inventory. How old is it? Old inventory is money wasted sitting on the shelves, tied up in inventory. This ends part 6 of inventories. Next video will be part 7, and that will be some more examples on FIFO, average cost, and LIFO.